The Dow tops 44,000 for the first time, although it doesn't look like we actually finished above it. And the S&P 500 climbed above 6,000 on an intraday basis. Joining us is Ariel Investments Vice Chairman Charlie Bobrinskoy and Hennion and Walsh Asset Management President Kevin Mahn. It's great to have you both here. Kevin, you're sitting on set with me. I'm going to kick off this conversation with you because we had a huge week for all of the major averages. The Russell 2000 were less than 2% from a new high now. We finished up almost 8.5% on the week. Walk me through where we go from here in markets, since so much of this seems to be the removal of the election overhang.
Yeah, the markets need to take a breather, and investors shouldn't expect the markets to continue to accelerate at the pace they have this week, or essentially since the beginning of 2023. However, I do think there is more room for this bull market to run. We did the research. We went back to 1946, and we've seen that there have been 12 bull markets historically. Average duration, 5.3 years. Average cumulative return, nearly 178%. We're about 2 years into this bull market and about 50% higher. And I know this time could be different, Morgan, but if history averages just hold up, that means we got potentially another 2 years to run and perhaps another 100% upside from here.
And Charlie, we have seen tech stocks, the mega cap tech stocks, excluding Tesla, perhaps, really lagging here this week. And we have seen other parts of the market catch a much bigger bid. I just mentioned the small caps, the Russell 2000. But it does seem like we have this unwinding of election-related hedges. We have a VIX retreat. We have favorable seasonality. We have return of buybacks, the so-called animal spirits, and a sense of FOMO in the market right now, deregulation and tax cut expectations. And then, of course, more recent support from rate stabilization as we've seen the 10-year Treasury yields basically do a round trip here to its pre-election levels from earlier in the week. Where do you think we go from here, and what looks compelling at these levels?
Well, I'm glad you mentioned Russell 2000. We wouldn't mention Russell 2000 value, 2,500 value. Small cap and mid cap value has lagged for several years. There's been a lot of talk about how this market's gone too far, too fast. That hasn't really been true for value stocks, and we've had a wonderful week this week for value stocks. Basically, it's not so much what Trump is going to do and the new administration is going to do, it's what's not going to happen. We're not going to have a big increase in corporate taxes, which people thought we were. And we're probably going to have less regulation on regional banks, less restrictions on M&A, which will be very good for regional banks. We probably have too many banks in this country. The energy industry is probably going to do better than they would have under another administration. The one big wild card is tariffs. Markets don't tend to like tariffs. Markets like free trade, and how that all shakes out is definitely in the to-be-seen category.
And Kevin, I want to get your thoughts on what we are seeing in the bond market, because we had been hearing that it was a sell Treasury trade tied to a Trump win. And yes, we did initially see that, but the fact that we've sort of already moved past that. What does that tell us? And I say that in a week where we also got a Fed cut.
Yeah, and we also see now that the spread between 2s and 10s have narrowed to 5 basis points. Could it invert again? I certainly hope not. But I think what the bond market is telling us is that they believe the Fed is going to go much slower from here. I don't think they cut in December. In fact, I think next year they take a much more gradual approach to rate cuts, perhaps quarterly, until they get to their neutral rate forecast at 2.9%. Given the uncertainty around potential tariffs and the uncertainty around the inflationary impacts of said tariffs, I think they're going to be much more cautious cutting interest rates unless the economy slows considerably more, unless there's more distress in the jobs market.
So quickly along those lines, then, what do you buy? I would imagine domestic manufacturers that are tied to things like national security all of a sudden look more compelling in a tariff environment, or regardless of a tariff environment.
Regardless of the tariff environment, I'm very bullish on aerospace and defense. There was momentum in this area during the Biden administration. I think that momentum only accelerates during the upcoming Trump administration. And we need to replenish, we need to upgrade, and we need to modernize our defense capabilities. And 3 names that we hold at Smart Trust in each one of those 3 areas. First, as it relates to replenishing, how about General Dynamics and our need to replenish ammunition and military warfare capabilities? And then if you want to look at upgrading, how about a name like L3 Harris? in terms of upgrading our missile defense capabilities. And then a smaller cap name as it relates to modernizing Kratos Defense and Security Solutions, drone technologies, which will allow us to have unmanned and less casualties in the event of war or defense situations. Those are three areas, I think, that are going to benefit from the upcoming administration, but they were already taking place during the Biden administration.